Hi everyone, welcome to this Decision Lens webinar in association with Innovation Enterprise. I'm delighted to announce Kevin Connor, Chief Product Officer at Decision Lens, who will now present the Evaluation of Risk and Reward in the Systematic Selection of Innovation Projects webinar. There will be time for a Q&A session at the end, so please feel free to post your questions at any time in the Q&A box situated at the bottom right hand side of your screen. The recording of this webinar will be available within 3 working days. Over to you, Kevin.
Thank you, Chloe, and good afternoon or good morning, everyone, depending on where you are. I'd like to welcome you to our webinar today. We are going to talk a bit about the risk and reward evaluation of innovation projects. What we have is Decision Lens is a strategic prioritization and enterprise resource optimization solution for that critical decision making in R&D and innovation. Decision Lens works with a number of global organizations, ranging from oil and gas to transportation to aerospace and pharmaceutical. All of them tend to face the same challenges, the same underlying problems regarding investment in R&D projects. And as anyone who's a practitioner in the field knows, a lot of this has to do with the evaluation of the value of an opportunity, as well as an understanding of the risk and the enablement of that for your organization's ability to execute it. So I knocked around the University of Pennsylvania for a time in my earlier life, and I can't get through a presentation without a quote from good old Benjamin Franklin. And I think he made a very sort of astute point here, saying, "I conceive that the great part of miseries of mankind are brought upon by them by the false estimates they have made of the value of things." And we see this time and time again in our practice. Organizations, forward projects that are believed to be highly valuable and highly financially rewarding and low on risk from a technical capability standpoint or from an organizational enablement standpoint. And 2 or 3 months down the road, they find out that these things are not so valuable. They're very risky. The sort of situation has flipped on them. And what this really helps us with is understanding how these challenges play out. And we'll look a little bit at how Decision Lens helps with this problem. So for the top 1,000 companies last year spent $638 billion on R&D. That's a $35 billion increase over 2012. And the top 100 companies accounted for about 45% of that. So there's a significant drive to invest in R&D opportunities and to create new value by breakthrough innovations. We've seen over time there's been a trend towards some short-term investment to try to meet short-term financial needs of organizations. But the trend is starting to shift a little bit again, and we're starting to see more investment in new R&D opportunities. Given that, it's important to note that some of these statistics that have come from various sources, if we look at what Forbes has said, over 250,000 new products launched annually. Of those, Booz Allen and Company have said 66% of those fail within the first 2 years. And the Deloitte and Doblin Group have assessed that 96% of all innovations fail to return their cost of capital. With that, it's critical to understand that innovation is absolutely fraught with risk. It's hard to pick winners. We've heard from some customers. I had a call with a gentleman a couple of weeks ago who stopped us in the middle of our conversation and said, you've seen the studies. A chimpanzee is as good at picking stocks on the stock market as an individual. And we said, well, at the end of the day, it's a group of chimps is probably smarter than any one chimp. And if we have the ability to kind of bring people together and make these decisions, we can get a much better insight into what the value of things are. And the actual cause of some of the problems in innovation are a little dynamic we call shift happens. And if we sort of look at the example of a portfolio life cycle, every organization comes out with their strategic planning goals to drive a really strong revenue picture. And that's assumed to be fact when it's first assessed and evaluated. And with that, a desire to see a certain net income result. And typically what will happen is that over time, we find out that this picture doesn't quite play out. The statistics are pretty clear that most organizations only reach about 60% of their strategic planning goals. And what ends up happening is that some of your largest resource flexibility to diversify your portfolio and create new opportunity is often behind you before you realize it. So you assume your best days are ahead because that's what your plan says. The realities are it's very difficult to achieve those plans, and the risks in innovation and the revenues and returns from it tend to create this squeeze in the middle of a portfolio that really limits your ability to invest and diversify. So it's important to proactively identify those risky opportunities, ring fence resources against them, and create the opportunity to create new value as you go, as opposed to, this rear view mirror look of like, we really had a chance to do it in the past. And we've seen this play out in the market over and over from multiple companies. You see them in the news. This happens a lot. And this is usually where the corner turns and you see a lot of merger and acquisition, divestitures happen because this is not a sustainable situation. So what really puts this sort of no in the innovation cycle here is you come out of your strategic planning goals with an already identified gap. Everything the organization has line of sight to execute is not enough to actually achieve their planning goals. So what this does is it drives a short-term focus. What can we do? How can we fill the gap? What quick projects can we scheme up that can help us get to the number? This drives a real need for speed in the organization, which creates a dynamic around a limited amount of due diligence about the actual value of opportunities. You churn your resources on all this close-in stuff and burn them out a little bit. There's some suboptimal performance that's a natural byproduct of that, which feeds back on the gap. You create an increasingly risky environment, which next cycle drives you into an even more intense short-term focus. There's some budget cuts that happen because the top line numbers aren't being met, and there's a neglect in the pipeline investment that just drives this gap into sort of a downward spiral. What we advocate for and try to help our customers and clients with is the ability to actually change the game a bit, to have insight and use different analytics to understand what the real portfolio of options are, how to make those selective strategic investments that balance off the short and long term, create a resource efficiency where some of the things that you may not think are promising today set the stage or lay the foundation for real opportunity tomorrow, but you decide to invest in that because you find other ways to close gaps. You create an acceptable mix of performance with some risk and reward. You get some return on investment, you manage those risks, and you continue to invest in your pipeline and grow. And so we've seen the ability to sort of change that picture from the former to the latter here, but it requires a lot of discipline and insight into what's actually in the portfolio. And this doesn't typically happen through what I'd call sort of advocacy-based conversations where, a group of people sits around the table, the loudest voice in the room either gets their project funded or the most clever advocate sways and influences people to get their project funded. We need to bring to bear on the matter a lot more fact and data and sort of objective evaluation. At the end of the day, all decisions are somewhat subjective, but the most we can do to sort of quantify that objective opinion, at least make it transparent and explicit for people to deal with, the better chances they have of actually making better choices. So what we hear a lot of times is organizations will say, well, we're very good at this. We've been calculating our expected net present values for years. We've got a very good discipline around that. And thank you for your multi-dimensional approach to trying to evaluate this and the analytics and insights you're trying to bring, but we trust our NPV. And my question typically to organizations that have that paradigm is, well, if that were true, there'd be no reason for you to join this call today. There'd be no reason for us to have any question about what to invest in. Your organizations would endlessly and continuously be creating a return on equity because you would pick the biggest NPVs. And if they're right, you'll invest in them and you'll do the smartest things for your organization and you'll continually create value. We know that doesn't happen. There's something else going on. Those numbers are forecasts. The forecasts are inaccurate. They're crystal balls into the future. The discount rates are hard to ascertain. Your opportunity cost is at play. NPVs, although dealing somewhat with variability, certainly assume a much more static versus the dynamic future. They don't account for sort of management intervention and expansion and abandonment options. There's a lot of things going on here that are not simply captured in an NPV. So what we try to help organizations do is to triangulate a bit on a better understanding of what their portfolios and opportunities look like. The financial piece is certainly a critical and instrumental part of it. So from the ability to quantify and do those forecasts and run the calculations, it provides a dimension and an important dimension and an element to try to make the assessment. However, there are a number of strategic and qualitative things that relate to the types of markets you want to attack. The capabilities and competencies within your organization, how it aligns to your known channels of distribution, et cetera, et cetera. Many things on a strategic level influence whether or not those numbers can be trusted and are valid. And at the end of the day, humans have to enable this. We have to find the people who can actually go out and say, okay, we can make this happen. We have the right skills in-house to do this, and we can align them over the right time frames to the programs and projects we're trying to execute in order to be successful. So in our opinion, it's much more of a three-legged stool approach: the financial assessment, strategic and qualitative assessment, and this human enablement aspect. And our approach is really to suggest a much more blended view of this than any one-dimensional view of it. So what we really strive for is this alignment to the goal being a bit better. It improves the rigor of our screening processes. So we suggest adopting a multi-criteria approach and rate projects along several key strategic dimensions to understand their benefits and how it's related to innovation in the organization. So the expected value can be broader than just those financial estimates. It can be things like the size of prize and gross profit, but it may also be fit with strategy, time to market, various things like that. The levels of innovation, how it provides consumer benefit, the durability and sustainability of those innovations, whether your portfolio is skewed toward transformational big innovations or a balance across those in your substantial and incremental types, and all the things that contribute to the probability of success, the competitive landscape, technical synergies, operational synergies, how well you can market and sell, and the resource intensity and the demand on the organization to get these things done. So when we take this approach, we see a much more balanced view of portfolios being taken, usually a couple of surprising insights around the kinds of things that should be done as a result. So what we do is we try to go in and look at things on different views. Can we look at them from, if we had all of the liberties in the world to do whatever it is we would like, if we took out all the constraints we could possibly have, what do we see? If we do it on a purely priority basis, based on a value metric, how can we decide what to do, and look across these in different frameworks and compare them, and then ultimately try to align the resources, at least at a macro sort of strategic resource planning level, to see if we can enable the opportunities. So with that, I want to show you just a little bit about how the solution works and some of the things that it can do. And we're going to go in here and share my screen with you. Okay, so what we're looking at here is an example of the Decision Lens solution. And what we show here is on the upper left corner, you can see this sort of value model that we've built. It includes things like business strategic fit, and it's a completely customizable framework, but it may include things like enabling geographic expansion or sustainability. Whatever the organization's strategic pillars are can be built into a framework like this, and we have a series of what we call decision blueprints that codify some of these frameworks, at least at a generic level, to give organizations a jump start into the kinds of dimensions to consider. And we may look at things like product competitive advantage, market attractiveness and its sub-factors, size, share, growth rates, competitive situation, leveraging core competencies, technical feasibility, financial reward, and some of its characteristics. And as you can see from this list, it is a blend of sort of qualitative assessments that may require the input of subject matter experts who are best informed as to the quality and capability of some of the opportunities. Others of these are quantitative measures that someone has calculated or we can pull out of a system of record and integrate to and bring them into the solution. But what we do is we normalize them all and create a blended model. So let's look at what that means. And now once we have an underlying data snapshot, what's very interesting is we could say, okay, our most important factor is our strategic fit, followed by that financial reward and some of our other factors. But we really have a sort of static data set at the bottom, which has our current best estimates and our best thinking from our subject matter experts about the performance, forecasted performance on all of these dimensions. And what's interesting is to sort of query this and ask it some questions. So if we purely believe the financial measures, if that is our point of view and perspective, we can see how our data set changes. And what we see is projects like Riviera, Mango, Honeycomb, they jump 17, sometimes 24 places in rank in the list. By virtue of looking at that metric alone. And we can go into the sub-metrics of that and see how some of those play out as well. If we wanted to see it just on a NPV basis, we could go understand that, what's the largest NPV projects versus the least. And when we go through this, we can kind of see how the various dimensions play out. And if we went into the discussion about the finances and we said, well, let's take the opposite point of view, actually, we don't trust the forecast at all, what would we do from a purely, business strategic fit, leveraging our competencies, capability standpoint? We would get a very different list and see which projects are most sensitive to that change. So this really helps us with an understanding of how volatile some of the opportunities are to the different assumption sets that we're using to make the evaluations. And once we do this, any insight that we gain along the way, if we look at this financial view and we say this is really compelling, we can save that and use it later. And I'll show you in a moment how we do that. But it's very powerful to be able to do this and look at this and sort of query and use this what-if analysis to understand the dynamics of the portfolio. Now, once we've done that, what this really enables is our ability to do that macro level resource planning to see, given our opportunities, is there really any chance to enable this, execute it, and create actual value from it? And what you see here is I've taken the entire list of projects that we have in this portfolio and I've laid them in across a 5-period time horizon. It could be 5 years or whatever. And I've turned them all on. I've tried to fund them all. And what we can see is we have 4 different pools of resources here, which could be P&Ls or product lines or even human resource types if you're talking about engineering, supply chain, operations, et cetera. Whatever resource types you want to look at and whatever divisions there are within them, we can create that structure and then allocate the resource demand into the projects below and see exactly where the bottlenecks are. So when I turn on everything, obviously we have a significantly bottlenecked situation. We have about 11.2 million in requests against a 4.7 million budget. How would we possibly do this? We can't. We know that. What the algorithm does in our solution is it goes and it uses that value model and whatever priorities and influences I have made most important in that value model to try to extract the most value from the opportunities and to debottleneck the resource constraints as best possible. And here you see we've actually done that. It's turned some projects off. It's shifted some in time. We've taken away all the constraints. And we've achieved 53% of that total available value in our value model that we created. So this really lets us kind of dive in and see how to scenario plan rather quickly what we might do. I want to show you here for a moment, if we look at the approach to the financial based only scenario that I talked about earlier, we can look at that and it'll show us how it would have made a different set of selections on the financial basis only, and we get a slightly different portfolio score on our analytic because it's drawing the value out of only the financial metrics that we used here. And we can do that same approach to optimization to try to say, okay, what would a plan look like that extracted the most financial value and minimized our resource constraints and gave us the best chance at enablement? What we can do with this, though, is I took that view, the financial-based view, the multi-year optimized view, and the non-financial view that we looked at earlier, and I can compare them all side by side. And this is where things actually get most interesting because this is where some of the insights pop out. We can see here orange represents the color for the financial metrics. We're using solely financial metrics as a selection criteria over here in the first scenario, and we can see that it gives us about a 20% better result than the non-financial view. And in the middle result, we're using sort of the blended model. So we see no orange here at all in the third scenario because we're not considering the finances at all. But here we're using a blended view in the middle and a purely financial selection view on the left. So we can compare and contrast, and we get a better financial result at the risk of some of the stuff around leveraging core competencies and product competitive advantage if we dive into those analytics. Also, we can see where the budget requests are coming from based on that platform schema around the different pools of money, and where the requests are coming from. So our budgets versus our requests, we can see, we're budgeting a little bit for Delta, but Delta's asking for a lot, ultimately gets allocated most of the money it has available, but not all. And we can see some of these different dimensions. Most interestingly here, if we look at the bottom one, which looks at the regions that some of these projects are assumed to support, that our middle view, our balanced one, neglected the European region completely. And it gets some money in the financial-based view, it gets some in the non-financial view, but for some reason it gets cut out here. And the question is, what's going on, right? So we can actually look across these portfolios and see with this technique we use to show, here's the opportunities that are always funded in all 3 scenarios. These are robust. They make the cut almost any way you look at it, given the frameworks we're looking at, and we would do those. These never make the cut. They don't get above the line on a value to cost kind of an estimate anywhere we look at it. What's most interesting is this sort of group in the middle that make it sometimes and don't make it other times. And if we were to dive into that and look at our European group, for instance, 3 projects kind of bounce on and off the margins a little bit here, and they tend to be, in that transformational innovation group, we can see there's 2 projects really competing for viability, and we can go in and look at what's the real difference between them. And if we look at this, we can see kind of on a dimension by dimension basis, again, we can zoom in or zoom out to any level of scale here to the submetrics if we wish, but we can see things like technical feasibility are relatively similar, business strategic fit, relatively similar, even market attractiveness within a spitting distance of one another. The real trade-off between these 2 projects, Mango and TopCat, which has a lot to do with the funding of that European region, is based on the fact that one is a highly financial rewarding project that doesn't leverage our core competencies, and we're not clear on the product competitive advantage because it's a bit of a new space, versus something that leverages our core competencies. It's a known product competitive advantage, but doesn't quite have the same return. So that trade-off and those projects that are sometimes in and sometimes out for that specific region become very clear, and we can go have a much more informed and analysis-based conversation about whether or not we should make that funding decision. So with that, we can go into a lot of other analytics and visualization types. The sort of the classic the bubble plot view here, which lets us see how these things stack up in different places. We can see them by region. It gives us a lot of ways to slice and dice the portfolio. Once we have that underlying data set captured, we can create these different scenarios and scenario plan and understand the trade-offs and implications very quickly. So let's jump back to the last couple slides of the presentation now. So what we feel is that using a consistent approach like this to evaluate innovation opportunities really provides a strong counterbalance to some of the hype, optimism, and sort of gaming biases that people run across in innovation project selection. And what we mean by that is that I'm sure you've all seen the hype cycle in product development, right? Something is a great idea, it skyrockets up to the belief it's the best thing since sliced bread. You start working on it, it goes down into that valley where everybody says, geez, I don't know if we ever should have started this thing. And then it levels out somewhere around its real opportunity. That optimism and hype gets a lot of projects a lot further down the pipeline than they should. Some of the gaming is related to that single point advocacy of either a strong financial analysis, a strong project champion, people who can sway and influence the organization to see things from a specific point of view. If you bring this balanced multidimensional view, query it, sort of scenario plan through it, you start to see a lot of interesting implications of the choices you're making. And it results ultimately in what we've been able to do through some studies. We've used a couple of actual data sets. The challenge in this, as you all know, is when you're sort of forecasting the future, we can't run a double-blind study to say how much better is our portfolio than one you would choose from a sort of purely financial basis. But we have been able to run the numbers in a simulation standpoint. I'll tell you something interesting about that. If we take a portfolio and we select solely based upon the largest NPVs until we run out of resources, versus using this multidimensional algorithmic approach to finding the best portfolio, running 100,000 simulations, accounting for the risk and variability in those financial assessments, et cetera, we have found that 80% of the time we perform a portfolio in this simulation that's about 20% better. And that's no surprise because the numbers are skewed. And it goes back to the earlier point that if the ENPV is right, none of us have a conversation today. We all go invest in the highest NPV projects and our organizations continue to grow. And that is the challenge is that somewhere in that, we need to find that balance of how various strategic elements that align our opportunities to our markets, to our organizational capabilities, to our strengths and weaknesses makes a much better chance for success. And that actually bears out in simulations with the numbers. So we get a more balanced portfolio along all key strategic dimensions when we use that kind of an approach as opposed to a single dimensional view that uses finances or whatever to select. So I hope this has been informative and at least stimulating from a sort of a thought standpoint. If you want to learn more about what we do, I'd encourage you to go to our website, decisionlens.com. There's videos there, some research we've done, a series of resources on innovation. Our innovation.decisionlens.com website will provide you a lot of the resources and further insight into some of the things I shared today. And please join our portfolio thought leadership group on LinkedIn. It's called Leaders in R&D Portfolio Strategy. It's a moderated and sort of a hosted site where pretty stimulating conversations are happening. We're looking for best practices and for more people to join the conversation. Please don't hesitate to jump in there. So for me, Chloe, that's it this afternoon. We'll go to the Q&A section.
Thank you very much for that. It was a great presentation. I'm sure everyone will agree. We are having a couple of questions coming in at the moment. If you can please share your questions, and we will try and answer as many of them as possible. A couple that have come in are asking whether we are going to share this presentation with everybody that has attended and everybody that has registered. And yes, we will absolutely be sharing this presentation with everyone. So please feel free to ask whatever questions you have, and we will get back to you live, and then you can watch this later on. Another question we have in is from Benjamin. They have asked, how do you enter criteria and evaluation models?
Sure. So there's several ways we can do that. Actually, as I mentioned quickly, but let me elaborate a little bit more on it. We actually have a series of what we call blueprints, and those blueprints are sort of research-based models, thought starter models for people to consider their space. So for R&D project selection, for instance, that's the model I just shared is a bit of an archetype. It has all the usual suspects in it: strategic fit, technical feasibility, financial reward, et cetera, et cetera. And to do what you do is you adopt that sort of, if you want, you can adopt that blueprint and simply customize it. It's a very nice user-friendly interface. It's a very drag and drop kind of a thing. It has a brainstorm list. You can add criteria, pull them into your framework. So there's a very sort of customizable, user-friendly interface that allows you to make that model be however you want. We can also have that built using our professional services team can actually work with an organization to get a group of key stakeholders together, perform some interviews, and build a draft model for them. So there's a couple of different ways to get it in. We found most people are quite successful at adopting and customizing the blueprint. Others prefer to start from the ground up and bottoms up that framework, but getting it into the solution is very straightforward. It's basically, type them or customize the ones that exist, but it's pretty easy to adopt.
Okay, thank you very much. We have another question in here from Sam. It says, our tech innovation portfolio is complex. Most projects are up to fair evaluation, but honestly, there are some projects that we just have to do for various reasons. What is the best way to handle this?
That's a great question, Sam. Actually, one of the things that we like about our solution, I've always enjoyed the fact that it doesn't let you, let's use the term, kind of whistle past the graveyard, right? So if we put in the whole portfolio list of projects, our best practice has been those must-do projects, we fund them. We can force them to fund in that algorithm. The algorithm doesn't require that it select the project. You can go in and say, do this one, do that one, do the next one. And you can force them in. But once you force them in, their resources have been now taken from the supply side for that demand, and you're left to optimize against everything that's left. What's a very, very compelling picture is to do that with the things that you've forced in versus the things that you have available, and then run an unconstrained portfolio alongside of that that says, based on our metrics and analytics here, what's the best thing we could do if we did not have those constraints? And again, it lets you frame that trade-off discussion about the differences and the sort of compare and contrast between if we took those constraints off of ourselves, what might it mean, versus if we commit to those things and have to do them, what's the picture? So you certainly have the flexibility in that scenario planning to lock projects in and say, you must fund them, we have to do them. But what it allows you to do is compare and contrast that with a world where you didn't have to do them and what you might be leaving on the table as a result.
Okay, thank you very much. We have another question here. It says, thank you very much for the presentation. We totally agree that evaluating risk and reward requires both data and judgment, but there is limited time for face-to-face meetings, and our stakeholders are dispersed across the world, making it difficult to include the right people. What are your best practices?
That's a good question. I didn't want to make this sort of too long a commercial for our solution, but there are the ability to actually assign out evaluations in a survey-based view. So for instance, if I were to select a set of transformational innovation projects in our portfolio that are being evaluated or best evaluated by our advanced research team, and our advanced research team is halfway around the world in another time zone, what we can do is we can have the solution query them, provide them a survey that asks them the questions that require that sort of qualitative input, or even if they have data points that they can enter, they can provide that as well. But we can send that to them. They can do it sort of at their convenience or on their own time with a provided deadline, and it's pulled into the solution and added to the data set and becomes part of the aggregate analysis. So we actually have quite extensive capabilities in terms of virtual collaboration to pull people into the process.
Thank you very much. We have another question that's just come in, and it says, so you say NPV alone isn't the answer in pharma. Probability of technical success is another typical go-to for prioritizing projects. Is this adequate?
Yes and no. I mean, I think that's the point of our approach, and where we have found we've been able to create a tremendous amount of value for organizations is around that compare and contrast again. So if NPV is one and PTRS is another, and your technical feasibility is another, and your alignment to your organizational capabilities and competencies is another, is any one of those the correct measure? Probably not. They are all single points that exclude a view of other critical dimensions, right? So how do you create the right blended influence model to understand which of those do you have the most confidence in or the least confidence in? Give them more or less influence in the valuation metric, and let that drive out the different scenarios that help you understand what the differences are. Because what we find is typically, and I kind of shared it in that example, you'll see that 70% of the things are always good. You look at them from any perspective, they'll make the cut. They'll be in that always funded category by the algorithm. And then you'll have a series of things that are not. And where the real difference is, that can amount, honestly, to tens of millions of hundreds of millions of dollars, is on that margin of which one do you choose on the what do I trust more dimension, right? So we want to be able to size all of that up as transparently and coherently as we can to have insight into that, to understand exactly what we're trading off and what the dimensions are that make these compare and contrast analyses really critical.
Okay, thank you very much, Kevin. And we have another question. It is, in our early stage innovation portfolio, projects cost and timing are inexact. Does this compromise the risk and rewards analysis?
It doesn't actually compromise it, but what we suggest is that people update the analysis periodically, right? So as new information becomes available, it's good to revisit. And it's very much that same approach I alluded to when we talked about what do we do about the projects we must do. It's sort of that same idea of we're confident in the assessments on a particular project, so let's lock that one in. The ones that are most variable or most volatile and have the least certain estimates, we might want to let them continue to compete against newcomers. So new opportunities might arise by the next analysis horizon, where we say, hey, let's see if that project should continue on, or is there something better we could do. So it doesn't necessarily compromise it. I think it's important to keep track of it, though, and use a solution like this to understand sort of how those key variables are trending. Gives you a lot of insight into that sort of dynamic of really valuable, not risky, becoming really risky and not valuable. You want to always be on the watch out for that.
Okay, thank you. We have another question in here from Yo, and he asks, how are you assigning scores to various dimensions? For example, level of innovation. Is it pure qualitative exercises?
And that varies a lot. It depends on how well you have those defined. I mean, there are some different. If you do some research on this, there's some different scales for sort of technology readiness that are available. R1, R2, et cetera. There may be some well-defined scales that an organization has regarding a proof of concept has been demonstrated or a prototype has been developed. This varies a bit organization to organization, and it varies based on their maturity in making these assessments. And one of the things we've seen that's quite valuable about using this solution is it provokes exactly that question. Is my qualitative scale good enough, right? I have no data, but I know that this is a critical dimension. Can I do it? So I consider my technical feasibility. And if I'm using a purely qualitative scale that says, low to high technical feasibility, is that sufficient? What we found is often that people find the answer to be no, but over time, because they've started to try to understand the influence of that variable on their choices and the impact it has on their success, that codifying a framework like this actually drives you up the learning curve to make better and better assessments and adopt better and better frameworks for those evaluations. So I would say it varies a bit based on the organization, but like all things, it sort of starts at some level of maturity and insight that the organization has and grows over time.